We previously learned the conceptual importance of the curve. In this lesson, you'll learn how to set the curve. Setting the curve outlines a range of price, and the current price will be somewhere within that range. As such, the curve defines the field of play, if you will. Within these boundaries set by the higher time frame supply and demand zones, where price is currently moving, we can identify indications of where the trend should reverse. This allows us to assess the relative location of where our entries and exits are through identifying the bigger picture. Setting the curve is a simple three-step process. Recall that the curve is defined on the higher time frames. Therefore, to set the curve, we take the chart to the higher time frame in relation to our trading style and/or trading objective. Recall that if we're looking for daily income, our high time frame is a daily chart. If we're looking for weekly income, then we start with a weekly chart, so on and so forth. Once we've identified our high time frame, going from right to left on the price chart, step 1 is to identify the nearest quality demand zone. During this step, we use the 5-step zoning process, which you can review in Part 49, Lab Exercise 7, to identify the zone. To identify a demand zone, we start by looking down and left to identify a strong rally in price. Then we isolate the base using the base isolation technique, which you can review in Part 30 to draw proximal and distal lines. Lastly, we would assess the structural odds enhancers of strength, time, and freshness to score the zone. In the case of the high time frame zones, we don't use all 6 odds enhancers. Rather, we only use those which grade the quality of the zone structure. Step 2 in setting the curve is to locate the nearest quality supply zone. To do so, we're going to follow the same process for the demand zone. However, instead of moving down and left from current price, in the case of a supply zone, we look up and left from current price, looking for a strong drop or decrease in price. Finally, in step 3, we divide the range between the distal lines of each zone into thirds. This will section off the high of the curve, also known as retail prices, the middle of the curve, also known as equilibrium, and the low end of the curve, which is also known as wholesale prices. When sectioning off the range, we only use the distal lines of the zones because 1, we want to be able to trade between those lines within the zones of the higher time frame. 2, distal lines are our objective and the same for all zones. In other words, recall that we have 3 options for placing proximal lines. However, the distal line is always placed at the respective wick, which is furthest from the current price within each of our 4 zone formations. Now, why do we set the curve? Money is made when price moves in the direction of our trade, whether we go long or short. To stretch the potential of the money to be made, ideally, we want to hold our trade until and prior to the trend reversal. Since the curve defines the range of trend reversals, the curve provides us the maximum profit potential for our trade by defining the field of play for price action. Now you know the steps to set the curve and the sections it defines. After the upcoming lab exercise, we'll look at the curve as an odds enhancer. Before you move on, be sure to understand how the curve defines the range of price and trend reversals. Practice going through the 3-step process to set the curve. Be sure to understand how setting the curve provides us the maximum profit potential. Hope to see you in the next video.